So my name is Peter Horvath, and I work for Primerica Financial Services. When I was growing up, I always had a good work ethic, and seeing my father and mother come from Europe with a 3-year-old and a 1-year-old and 2 backpacks of clothing, life wasn't the easiest growing up, and there were times when there was no money. They put a lot on the line to bring their family to one of the best countries, if not the best country in the world. I always knew that I had an entrepreneurial mind about myself, so I always felt that I was going to get into a business for myself. So that kind of has always stayed the same for me. So that vision has been the same. I didn't know what I was going to do or how I was going to do it, but like I said, throughout life and different experiences in life, ended up being able to help families this way and make sure that, just as my parents came to a different country to better life for their children, I'm able to help people do that here on a regular basis. At 30 years old, I had my daughter, and when I looked at my daughter, I realized that life isn't all about yourself, and you gain a lot of happiness from being able to help others. And at the end of the day, what I wanted when my daughter grew up was to make sure that she would be proud of what her father does. So I find that going out and helping families to live a better lifestyle and be able to afford taking care of their families brings me a lot of joy. And hopefully one day when she looks back on what her father did, she can be proud of it as well. It brings me a lot of pleasure to be able to help families and see the relief on their faces when they're able to finally get out of debt, when they're able to breathe at the end of the day, when they finally have more money at the end of the week instead of more week at the end of their money. Find that this brings me satisfaction to be able to help them do that. And I realize that, like I said, helping families, putting other families first, brings you a great deal of satisfaction. So what I try and do is we educate families on how to save money and pay their debts off quicker. We also show them how to get a better rate of return, if possible, on their investments so that they can retire with a better future. Statistics show that only 5% of people right now in Canada are able to retire without having to go back to work or live off government assistance at the poverty level. So it's really important for people to know what they need to do and how simple it is to get themselves to be able to retire so that they can implement this in their life. And at the end of the day, when they go to retire, they can be confident in knowing that they won't have to go back to work and enjoy the quality of life that they've been striving for all of their life, or even maintain that quality of life instead of losing it. Helping people and knowing that I'm doing the absolute best that I can for them on a regular basis, I don't think you can go wrong with that. And no matter, there's all sorts of different avenues to help families, all sorts of different avenues and ways in life to make an impact on people's lives. I find this one is the best one suited for me, and I'm loving it on a daily basis. Thank you very much for coming out this evening. My name is Peter. I work with Primerica Financial Services, and I will be taking care of the wealthy portion of our seminar today. So for those of you who don't know, Primerica was started in 1977. It's publicly traded on the New York Stock Exchange. Love working for this company because what we strive to do is the best that we possibly can for families. We try to educate them. Other companies are realizing what we're doing. Forbes magazine just put an article out last August on the top 50 most trustworthy financial companies in North America, and Primerica was top of its class. Better Business Bureau gives us a top grade. So I'm really proud to be able to work for a company, and I'd love to share some things that I've learned along the way with you tonight. So if you have any questions, please hold them to the end. I'd be more than happy to answer them as well. I'd like to ask you to ask yourself 3 questions while I go through this presentation. Is there a need for what we do? Are these financial concepts helpful to you? And would your family and friends, if they implemented these concepts, would they be better off? Ask yourself these questions as we go through and answer them for yourself, and maybe perhaps write a few things down so that you can hopefully better yourself and make some educated decisions on what's going on in your finances. Because what they find is statistically 2/3 of families live paycheck to paycheck. 1 in 4 families have no life insurance at all to protect themselves in case anything happens. And more than half of all families have less than $25,000 in savings. This is a real and serious issue, and it's illustrated by this study that Smart Money magazine did. They looked at families, 100 families that worked from the age of 25 to 65, and they found that only 5% were able to retire financially independent. That's really scary when you think that people come from all over the world to Canada, because it is one of the best countries to live in, and yet even in one of the best countries in the world, families are having a hard time to make sure that at the end of the day, when they're 65 years old and they go to retire, they can live the same quality of life that they were expecting to have. So they found that 95% of them fail when it comes to their finances because they had no financial education, they had no financial game plan, and they had no financial coach. So at Primerica, what we strive to do is we strive to help educate families in these three portions of their life and make sure that they too can become part of the 5% retire financially independent, which I hope you would all agree with me is very important at the end of the day, because nobody wants to have to go finish working all their life at the job they've worked very hard at and climbed the ladder at to find out they ran out of money to have to go work part-time jobs somewhere else, right? And we see this all the time wherever we go. Part of the solution is to understand how you have to build your financial house. If you were to put it in an illustration, the first thing you have to do is you have to make sure that you can protect your income, because you can design a plan to get yourself to retire financially independent and debt-free. But especially if you're in a family situation or married or in a couple, if one of the person's income disappears and that financial game plan isn't viable anymore. So really, life insurance is there to protect the loved ones that are left behind and make sure that they can still retire financially independent, because living is very expensive, and as far as living the same quality of life after a spouse leaves is very difficult to do on half the income. After you take care of your income, you've got to look at your budget and eliminate your debt, because there's no point paying 21% on your credit cards if you're making 3 to 12% on your investments. You've got to make sure you can eliminate your debt, and after that you can look into your retirement and into your other goals and dreams. I'd like to take a moment and educate and talk about permanent life insurance policies. This is the theory of decreasing responsibility. Now, as we're all younger, what we can find on this side of the chart is that people have young children when they start out in life. They have higher debt loads because they're starting and getting everything new. They do have mortgages, and a loss of income would be devastating to paying all these bills. But if you have a proper plan in place, then your investments, even though in the early years you may not have a lot of money, your investments should grow and your responsibility should decrease, because your children will grow up, your debts, if you have a proper plan, will get paid off, and your mortgage is designed to get paid off hopefully at some point in time in your life too. As your debts and your responsibilities go downwards and your investments grow upwards, they're able to replace this. I would liken this to anybody here who has a car has to have car insurance, correct? So, if you didn't have a car, would you still pay for car insurance? Why would you still pay for life insurance if you didn't have any responsibilities for that to take care of? As long as you have a proper plan in place and are able to replace that, it's something that you can look forward to, and you can use that money to help yourself retire. So, when we look at life insurance for families, this is called coverage quadrant. There's usually only 4 types of life insurance that families can have. There are only 4 types of life insurance that families can have. The first type is no coverage, which, like we saw, a lot of families don't have that now. Looking at upwards of 50% of families in Canada not having any protection. There's cash value insurance, which has a savings portion and an insurance portion, both together. There's limited kinds of life insurance, which is your group insurance, which is your mortgage insurance, your loan insurance, which you really don't have any protection or any control of. And then there's term insurance, which is pure coverage. If you were to pass away, it would pay out for you. It asks the question here, how do you protect your family? Because everybody has a need to make sure that their family's quality of life, if something was to happen to you, you'd have to ask yourself what would happen to your family's quality of life. Most people want their family's quality of life that we meet to be either the same or a little bit better, heaven forbid something was to happen to them. So today I'd like to just educate you on two of the different types of policies that I come by when I go to see help families. The first one we're going to talk about is the cash value type of insurance policy, where companies will sell you a cash value policy. You will have a retirement savings plan built into it or an investment plan built into it. Now, although this is a 2-for-1 and it sounds like a great deal, a lot of families aren't educated, and there's a lot of fine print to read in the world. And the policies are really thick. Unless you go through and get educated on how to read these, a lot of people are overwhelmed and they don't quite understand what's in there. So think to yourself, please, what kind of a policy you have. because you can take this information that you learned tonight and make sure that you're properly protected and your family's properly taken care of. In a cash value policy, what happens is you have to have a savings portion and an insurance portion. So in this example of a 30-year-old person with $100,000 of coverage, they paid $100 a month, $50 towards their insurance and $50 towards their savings. Now, what they weren't told was for the first 2 to 7 years, and I've seen some policies up to 12 years, the insurance company keeps all of the money you put towards your savings portion. So if you were to go and talk to your insurance agent and see what is in your cash value policy, they could very well tell you, after 7 years you put $6,000 in there, how much has it grown to with interest? They tell you there's no money in there. A lot of people aren't aware that their savings are being kept by their insurance company for X amount of years, especially if you're trying to keep this money towards helping you retire. This person was promised after 35 years, they would have $50,000 in savings. This accrues at a really low rate of return. But even though they were told that once the money starts accruing in there, they could borrow it, they do have to pay it back in a lot of policies. I'm not sure how you feel about having to borrow your own money from your savings account, but not too many people are very impressed with that idea. Not to mention, when you do have to pay it back, you're paying it back with 5 to 8% rate of return, 5 to 8% interest on something that they're only giving you 1 to 4% rate of return to invest in the first place. So it's almost like working backwards. But at 65 years old, this person was promised $50,000 if they were to survive the policy 35 years later. What they weren't told is that if they were to pass away even a day before, in a lot of policies, the insurance company keeps your savings because this is a living benefit and this is your death benefit. So heaven forbid your family goes and tries to collect your savings portion of the policy, the insurance company would say, we're sorry, you only get the $100,000, we keep the $50,000 in your savings portion. So this is how a cash value insurance product works. And I don't know who here has heard of the book Wealthy Barber, but if you've read the Wealthy Barber in the original edition, because there are different editions now, page 84 and 85, they go into detail on these kind of policies. Also, Susie Orman, who is Oprah Winfrey's financial advisor, she goes online all the time touting about the cash value policies and the pitfalls of having one of them. So don't take it from me. Do some research into the kind of policy that you have, because you want to make sure that you're properly protected. You want to make sure that what you think you have is what actually you have. Term insurance policy is just like your car insurance. You get in an accident, the insurance company is supposed to pay out, right? So there's no savings plan, but when you need it, it's there for you. So on a term insurance policy, same 30-year-old person with the same $100,000 of insurance coverage, they only pay $25 a month instead of $100 a month. People are usually really happy to be able to save 75% of their insurance policy. But if you were to take that $75 in this instance that you saved and invest it over the same period of time the insurance company told you they'd give you $50,000, you could make, using the average of what the market has done, the mutual fund market has done, you could make $300,000 in the same amount of time, which is willable to your family. You could take away from that if you needed to throughout life. You don't have to pay it back. If, like I said, if something was to happen to your family, you get the $300,000 as well as the $100,000 in coverage if you were to pass away. So usually if we show this to families and they have the one policy, you're able to see this right in your policy. So if you go home and you open it up, and if you needed a hand, me or one of my associates would be happy to give you an honest answers to what you have, because they're hard to read. But the second type of insurance is even more widespread, and that's mortgage insurance. A lot of families have mortgages, and a lot of families want to make sure that if something happens to them, that their family would still be able to live in that home. Now this comes, and actually CBC News reported on this because this is becoming a kind of an epidemic. So they did an expose on what actually happens to families, or what can happen to families if they have mortgage insurance. And the link for that is right there, and I can give that to you afterwards if you'd like to check it out. It's about a 19-minute video if you were to watch the whole thing. But as far as mortgage insurance is concerned, a few problems with it is that this is an example of a couple that had a $250,000 mortgage. So you have $250,000 of coverage when you begin, and you pay your mortgage down. So you'll find that if you do the math on your mortgage insurance rate actually goes up even though the amount you're covered for goes down over the term of your mortgage. And paying more for less isn't something that really most people want to do. Other downside to this is, so in this example, they pay $45,000 over a 25-year period to have their mortgage insured. Keep in mind that if both spouses are insured on this mortgage, if both spouses were to pass away at the same time, the insurance company keeps the second policy, even though both spouses were insured on the mortgage. They would pay off the house, and they would keep the difference for themselves, not give it to the children or the family. Coverage is also not guaranteed, and you'll see that if you watch the video, that they do their medical underwriting after the person passes away. So they go in and they check afterwards if you're eligible for the insurance policy. And many times they don't pay out because they find a reason not to. Now, if you compare this to term insurance once again, the same 25-year term mortgage for the same amount insured, you can see that your mortgage insurance not only is cheaper to begin with, but it goes down as the amount that you're insured goes down, which makes sense. Less you're covered for, the less you have to pay. Total over 25 years would be, an example, be almost $20,000. So that was a savings, average savings of $85 a month. Keep in mind that if you were to invest that at lower than market rate at 9%, over the same 25-year period that you had your mortgage, if you just invested those savings, you'd make $96,000. So in the same amount of time that you paid your mortgage off, you'd have $100,000 towards retirement with just your savings on mortgage insurance. And like I said, the numbers aren't there, but if you watch CBC News, they go over some of the pitfalls and the ways that the insurance industry works when it comes to the mortgage industry. So keep in mind, if you or your friends or anybody has it, please look into this to make sure that you can better off your life. Better off not only yours, but if something does, heaven forbid, happen, that your spouses and that your families are properly protected and taken care of. Because there's nothing worse than going through all that kind of grief and then finding out on top of that. You see families all the time on top of that, what they thought was there to protect them isn't, which is very scary. But the good news is once you have your life insurance taken care of, you can look into your retirement plan. So the first thing you need to know and that I would recommend is figuring out what your financial independence number here. In this room, I would ask everybody to ask themselves if they know what their financial independence number is. It is the amount of money that you'll need to accumulate so that someday you can live off of that money for the rest of your life and never have to go back to work. So hopefully at some point in time, you've all sat down with somebody and they figured this out for you based on inflation. Just think to yourself if you have that, because that's very important to know. This is why a lot of people find themselves, they thought they had enough money to retire, didn't work out, and they have to go back to work after they were able to retire for a couple years. And this number goes up, and we are more than happy to show you what that does. In this example, if you want to retire 30 years from now with $30,000 a year, after 3% inflation, $73,000 in the future will spend like $30,000 today. And we can see that. We all know that back in the day, a loaf of bread didn't cost what it does today. I remember going to get chocolate bars when I was a teenager that cost, I know she's looking at me like chocolate bars. But they were $1 a chocolate bar. You know, I go get them for my daughter now, and it's like $2.50 a chocolate bar, and I swear they're getting smaller, right? So inflation does keep up. It's silent but deadly, so to speak, and that's why it's important to know how much money you need in the future and what that total is. Getting there is the other half of the battle. And the last thing I'd like to share with you tonight is the rule of 72. Because you want to be able to get there with it. We like to help families out without having to break the bank. So if we can save you money here and there and show you how to invest that properly, you'd be surprised how far you can stretch your money. This is an illustration on the rule of 72. And for those of you that haven't heard about it, if you take the interest rate that you're getting on your investments and you divide it into 72, it will tell you the number of years that it takes for your investment to grow, to double. So, as we've just seen, inflation is about 3%. So keeping up with inflation, at 3%, if you were to take $10,000 and you were to invest it, it would double every 24 years. So 48 years later, you'd have $40,000. Who here, with a show of hands, thinks that they could retire with $40,000 in their bank account? Nobody. So, if you could double your rate of return to 6%, your money would double. If you take 6% and divide it into 72, it would double every 12 years. So that money would grow now. Instead of $40,000, you'd have $160,000. Now, if you were to retire, do you think you could retire happily off of $160,000? Still no show of hands for all of you in the front row. I don't see it. But, I mean, if you could show a family And we strive to show families how to earn up to 12% with their money. And the name of the game is to do it with as little risk as possible. So if you could show families how to get 9 to 12%, depending on how long they have, with low risk in that investment, then their money would double every 6 years. Who here thinks that they could retire if they had $2.5 million? Right? More hands go up. This is the power of compound interest. We see this work against us with credit cards. I mean, banks and credit card companies, they know what they're doing when they give us 18 and 21% rates of return, because they want to see their money double as much as possible. You can get this to work in your favor if you know the name of the game. Because how do you win the game if you don't know the rules of the game, right? So what we like to do is we sit down with families. We like to educate them on these concepts. We like to show them how they're doing and make sure that they're getting to their goal. Because families are striving and they're struggling. There's over $4 trillion invested in Canada. If you go on Statistics Canada, it will show you that 88% of that money is invested in less than 3%. Less than 3%. So if you can show a family how to get ahead, because you're going to have to spend a lot of money if you want to retire off of 3%. But it makes a big difference if you can show them how to do that at 12% with the same kind of risk. Does that make sense? So those are just a couple of different things. And I know that's a lot of information for this segment, this fun segment, but hopefully you each got something about that. Take advantage of the gift certificate at the table, the red gift certificate there. I'm not sure if I brought one up with me. But there's also the business card there. And this will get you a free assessment to find out how you're doing. No obligation, but it's good information to have. Whether you're young or you're old, if you can do better, we can show you that. And if you're doing great, then more than happy to tell you that you're doing awesome. Because you want to make sure, hopefully for you and your family, that you're on the right path. So feel free to take advantage of that and give myself or one of my associates a call. Perfect. And so with that, I will go back to Steve.